Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
We are plunging immediately into the asymmetric valuation of Syntec Optics, ticker OPTX, especially after what was a tumultuous but I think ultimately bullish December of 2025. This stock saw volatility that would make a veteran trader blink. I mean, a sustained spike of somewhere between, 18 and 25% right around that December 16th announcement. It pushed the price firmly into that 140 to 170 range, and on pretty significant accelerating volume. So the central question that's really emerging from the material is, is this upward momentum a rational market response? Is it a signal that they're truly transitioning from, let's say, an R&D science project to a validated prime supplier? Or is this whole movement just fundamentally capped by existential liquidity risks? I'm firmly in the first camp.
The tangible, validated deep tech potential here is creating a long-term moat that the market is just now beginning to price in.
See, I come at it from a completely different way. That volatility, while, thrilling to watch, is inherently unreliable. To me, the price action is structurally capped. We're watching a classic tug of war between let's call it the technological dream and the immediate financial reality. And I, for one, believe reality dictates the maximum altitude here. This price appreciation, in my view, serves less as a sign of fundamental health and more as a necessary opportunity for the company to raise desperately needed cash via its at-the-market facility. This stock is trading less on its tech potential, which I'll grant you is impressive, and more like a binary option that's based purely on whether it can survive the next 2 quarters.
Okay, but let's establish why the recent momentum is, I think, fundamentally organic. It's driven by technology adoption, not just, speculative noise. The market is reacting to very specific material catalysts that validate Syntec's entire proprietary tech stack. We saw 2 huge signals just this December. First, that $1.9 million recurring order for LEO satellite optics. Now, this isn't just another PO. This is crucial because it confirms the company has successfully passed the grueling qualification phase that's required for space applications. To meet the volume and, frankly, the extreme precision demands of this ongoing low Earth orbit space race, building on 2.6 million in prior shipments, that is a significant de-risking event. It proves they can scale.
A $1.9 million order is certainly material for a company with quarterly revenues of, around $7 million? But I have to reject the implication that it fundamentally changes the risk profile. It's an operational win, sure, but it's one that's being executed under a really severe financial cloud.
But wait, the second catalyst is the true long-term game changer. That's the December 16th OEM order for the AR/XR Soldier System optics. The specs they mentioned, micro-LED imaging, day and night readable visor displays, soldier situational awareness, they align perfectly with the multi-billion-dollar Integrated Visual Augmentation System program, IVAS. To define the moat here, the core asset is their specialized manufacturing, things like diamond turning and freeform prism molding. I mean, this lets them mold a plastic optic that performs with the precision and clarity of heavy ground glass, which drastically cuts weight for a soldier in the field. If Syntec's proprietary tech becomes to design and spec for the full-rate production of a system like IVAS, we are talking about exponential, decade-long revenue potential. Defense contracting is incredibly sticky. Once you're qualified and designed in, the logistical and financial headache of replacing you for the DoD is just immense. This is a high-conviction, long-term play on a critical component of the defense industrial base.
I agree on the technological merit, I do, but I have to give you a different perspective, one that's centered squarely on the balance sheet and what's often called the valley of death. All those technological wins you just cited, and I agree, they are impressive validations, are currently being performed in the shadow of an existential liquidity crisis. Just look at the Q3 2025 financials, which came out right before this rally. Revenue was $6.95 million, and they posted a net loss of $1.43 million. That means they burned through that much working capital. But the critical number, the one that matters most, is the cash balance. Only about $0.6 million reported. That's a 71% year-over-year decline. So to fulfill that $1.9 million space order and the new AR contract, the company needs raw materials, specialized labor, energy. Right now, They have to spend cash to execute on those wins. So with less than $1 million in the bank and burning over $1.4 million a quarter, that $75 million at the market or ATM equity facility, it stops being a strategic financial tool and, well, it becomes an operational necessity.
And why is that necessity a structural cap on equity holders?
Because the ATM mechanism ensures that every single rally, every one driven by the good news you just mentioned, is met with inevitable structural selling pressure. The ATM lets the company, through an agent, just drip feed shares into the open market during these periods of high demand to raise cash. They have to use these price spikes to raise that working capital. And this constantly increases the share count, the denominator, and it just fundamentally erodes shareholder equity. So the technology might win in the lab, but the investor's position is perpetually diluted in the market. You're buying a smaller and smaller piece of a future pie, and the current price action is effectively ensuring that the survival costs are continuously paid by the current equity holders.
Okay, let's pivot to the core debate then, because your point hinges entirely on the price action being driven by this cyclical need for cash. We need to dissect what is actually driving the massive volatility. And I agree, we have to dismiss the popular retail narrative that's driving some of this momentum, this belief in a short squeeze.
Right. I'm glad we agree there, because the short squeeze narrative, which is all over forums like Wall Street Bets, is demonstrably false. The objective data is crystal clear. Short interest is negligible. It's hovering between 0.2 and 0.33% of the float. On top of that, the days to cover is less than 1 day. I mean, a genuine short squeeze needs short interest north of 15–20%. There is simply no fuel for a squeeze here.
Exactly. However, that debunks short squeeze belief is instructive because the extreme volatility the market is seeing is very real. So I acknowledge the squeeze narrative is statistically dead, but that actually confirms my point. The underlying mechanism is long-sided momentum. It's driven by genuine news catalysts that are meeting a very unique market microstructure.
Okay.
The volatility isn't caused by manipulation. It's a function of how thin the order book is and where the trading is happening. The source material confirms that the off-exchange short volume ratio for OPTX is reported at around 27.7%. Now, that is significantly lower than broader retail-heavy stocks, where off-exchange trading, often in dark pools, can account for 40–50% of total volume. And this lower dark pool participation has a profound implication for price stability.
Which is that volatility is amplified, both on the way up and the way down. Dark pools usually act as these institutional shock absorbers for large orders, right? They prevent massive price swings. So when that buffer is largely absent, which it is here, price discovery happens primarily on the lit exchange, NASDAQ. This means that even relatively small buy orders, say 10,000 shares, can completely sweep the order book clean and cause those sharp double-digit percentage gaps and the extreme volatility we saw in December. The price spikes are a feature of real news, meeting a very thin, inefficient order book.
Exactly.
That's a compelling argument for the velocity of the move, but have you considered that this lack of institutional stability creates a massive downside vulnerability? This volatility isn't just thrilling, it's operationally dangerous. The lack of a dark pool buffer means stable, larger institutions are generally unwilling to even touch this stock, which just perpetuates its reliance on the ATM facility and keeps the order book thin. And what happens when the buying momentum inevitably runs out of steam? The structural selling pressure from that ATM facility is going to quickly overwhelm demand, and without institutional interest there to catch the volume, the decline will be swift and severe, much faster than a standard stock. And let's not forget the constant shadow hanging over this thing, the NASDAQ $1 minimum bid price compliance risk. The recent rally only bought them a little buffer. If that momentum reverses, they're right back in deficiency territory, where the threat of a reverse split becomes existential.
Right.
And a reverse split isn't just painful. It is often the nuclear option of microcap survival. It triggers institutional selling, it crushes retail sentiment, and it accelerates the exact downside spiral we're talking about. This risk is fundamentally created and made worse by the unstable market structure we've just discussed.
That brings us to the core tension then. weighing the proven technology moat against this capital spiral you're emphasizing. I believe the defensive structural value of the technology outweighs the immediate, confirmed liquidity risk, provided management can execute on these contracts. The ability to manufacture these specialized optics, whether for LEO satellites or for the IVAS soldier system, is a technical differentiator that is incredibly hard to replicate. I mean, the expertise required for diamond-turning optics to meet military specs takes years to build.
The source material highlights this difficulty. I agree. The technology is excellent, but the company is currently illiquid. It's a classic Silicon Valley versus Wall Street paradox. We have this spectacular engineering achievement, but the market is telling them we don't pay for prototypes, we pay for profit. That gap between a prototype order and securing stable, mass production payments, that valley of death, is just too wide for a company with $600,000 in cash and a $1.43 million quarterly net loss.
I'm not convinced that the risk is as high as you frame it, because the technological validation proves the company is not a zero, which is the biggest risk in the microcap space. The recurring nature of the LEO orders and the critical alignment with major defense programs, it minimizes the risk of the technology failing operationally. Furthermore, you have the dormant warrants, OPTXW, with an exercise price of $11.50. Now, while they're deeply out of the money right now, their existence sort of implicitly suggests a necessary long-term goal. If the prime supplier bull case materializes, a 10x re-rate toward that level is at least strategically possible.
That is a massive leap of faith, though, regarding the timing of cash flow break-even. You're assuming the new recurring revenue will hit the bank account fast enough to cover the capital burn before that ATM facility totally exhausts investor confidence. Right now, capital availability is not a variable. It's a confirmed constraint being managed through constant dilution. So even if the technology wins your scenario A, the company is forced into scenario B, the dilution spiral, just to survive long enough to reap the rewards. These price spikes are a mechanism to sell new shares, which means current investors own a smaller and smaller piece of the potentially profitable future you envision. That is the fundamental constraint. You buy into a spectacular technology thesis, but your equity stake is perpetually shrinking just to fund their survival.
And I would counter that the capital problem will resolve itself once cash flow break-even is reached. The only remaining variable is execution speed, which these recent contracts confirm is accelerating. So my thesis remains rooted in the operational stickiness of this technology. The orders are real, the moat is deep, and the price action reflects, I think, rational speculation on the exponential potential of becoming a sticky component supplier in the defense industrial base. The short-term liquidity risk, while I acknowledge it, is manageable given the strength and the difficulty of replicating that technical moat. The operational narrative is rapidly strengthening, and that is what the market is pricing in.
And I have to insist that until those operations generate sufficient free cash flow, the financial mechanism governing this stock guarantees dilution. The stock is trading less on those strengthening fundamentals, which are, let's be honest, still negative, and more as a binary option whose upside is actively capped by management's need to raise capital. Until the company's cash balance moves comfortably above its operational burn rate, every single rally will be used for capital raising through that $75 million ATM facility. That effectively guarantees perpetual dilution. That financial reality acts as an insurmountable cap on near-term equity upside for current holders, regardless of their technological prowess.
So we are left then with the fundamental tension that's really within this material, a small industrial firm that is successfully building the invisible infrastructure of the future battlefield through true deep technology, whose financial destiny hinges entirely on this delicate balance between execution speed and capital availability.
Precisely. It is a spectacular deep tech thesis that is constrained by the unforgiving mechanics of the microcap public market. There is much more to explore here as the next quarterly report approaches, when we'll see how quickly those December wins actually translate into cash on the balance sheet.
Indeed. Thank you for this exchange.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.